We have Uber, for example. So Uber was actually added to TRFM's tracking index 12 months before the S&P 500 added it. Stock price appreciated close to 100% during that time period. It's not going to it's not going to happen all the time, but we think that that's a good example of what TRFM could potentially bring to the table.
Welcome to all. I'm Brittany Mason with ETF Guide. With us today, we have Chandler Nichols from Advisors Asset Management. We're glad to have you watching and join our community by hitting the subscribe button along with posting your comments. We're glad to have you with us today, Chandler.
Great to be back.
Let's start with the AAM Transformers ETF, ticker TRFM. The fund has really picked up bullish momentum and is outperforming the NASDAQ 100 since the start of the year. What's behind TRFM's bullish move and what are some of its holdings?
Thanks for having me back, Brittany. TRFM hasn't been short of accolades, not only just year to date, but over the life cycle of the product's inception. So TRFM's been around for close to 3 years now, and it's not only outperforming the NASDAQ 100 year to date, it's actually been outperforming the S&P 500 since its inception. And it's actually in the top quartile amongst its immediate peer group over the past 3 years. So we're really happy with TRFM's performance. And, just to take a step back as to what TRFM is, this is a rules-based global thematic ETF, and it tracks the Pence Transformers Index, an index that selects its underlying constituents based on research and development expenditures and sales growth in order to really get exposure to really fast-growing companies and those companies that could even potentially be, acquired down the line by such larger companies. So, in terms of its overall performance and what's been driving that, one key thing to keep in mind with TRFM is its ability to call it manage risk in a riskier area of the market. Thematic strategies overall tend to be, they tend to lean towards mid to small cap growth areas of the style box. But TRFM is a multi-theme solution. So we're not taking one single theme bet. It has a constituent count of roughly 200 stocks, which are modified equal weighted. So no stock tends to hold, above 2% as far as the overall portfolio upon its quarterly rebounds. And what we really like about, and this is getting into the exposure now, what we really like about TRFM is how that all pans out as far as its final portfolio, because less than 10% of the portfolio are in the Magnificent Seven cohort of stocks. So think like your Teslas, Microsofts of the world, they're in the portfolio, but as far as their weighting in the overall portfolio, they tend to be lesser of that overall portfolio mix. So TRFM's value add recently has actually been found in its international bucket in recent months. So key themes like global defense, China internet have been some top contributing areas of the market that have been key to TRFM's recent performance. But TRFM and what we like about their strategy is that its ability to potentially add lesser known names before they end up getting added to the overall larger benchmark. So I wouldn't call this a lesser known name, but definitely a good example. We have Uber, for example. So Uber was actually added to TRFM's tracking index 12 months before the S&P 500 added it. Stock price appreciated close to 100% during that time period. It's not going to happen all the time, but we think that that's a good example of what TRFM could potentially bring to the table as far as portfolio application goes.
Well, congratulations on the recent launch of AAM, Todd International Intrinsic Value ETF, ticker TIIV. The fund is focused on finding international stocks that have been overlooked or undervalued. Tell us more about TIIV's strategy and how the ETF might be deployed by advisors and investors.
Thank you. And this is a launch that we've been really excited for because we're really grateful for the team at Todd Asset Management. So they are the sub-advisor for this strategy. And in fact, the strategy that underpins this ETF has been in existence for close to 2 decades now with a very successful track record. So we're really excited about what Todd brings to the table in the international equity space. Because of their process, their intrinsic value investing process, using their proprietary multi-factor ranking model. And it's essentially, what this multi-factor ranking model is. It's essentially a bottoms-up process where Todd targets undervalued stocks with attractive fundamental strength because in order to find those types of stocks for a portfolio, they feel that a quantitative-like approach through that bottoms-up process helps them find well-valued stocks that are high quality, not just in developed markets, but also emerging markets as well. A lot of international strategies tend to only concentrate on developed markets, but TIIV concentrates on the full pie. So from a portfolio application standpoint, we feel it's very easy for TIIV to slip right into a core equity portfolio because most U.S. investors already have that U.S. bucket chosen. So TIIV could be a great complement to those types of strategies in order to get that full global diversification as far as the equity sleeve goes.
Moving along, the AAM Low Duration Preferred and Income Securities ETF, ticker PFLD, invest in preferred securities with low duration. In a volatile interest rate landscape, how does this ETF manage duration risk while still delivering attractive yields?
Yeah, so I'm going to take a step back and just go through what PFLD is. And this is another rules-based strategy here on the AAM ETF platform, honing in on the U.S. preferred securities landscape. And essentially our selection universe for this portfolio is the entire U.S. preferred securities market, exchange-listed preferreds, and over-the-counter preferreds. Those $1,000 pars are included in that selection universe. So as far as the duration risk goes, from that selection universe, PFLD's tracking index will incorporate two filters. One is that duration risk screen, which kind of goes back to your original question regarding that. PFLD's tracking index is going to remove any preferred stocks that have a duration above that of 5 years. But for the other side of the fence, and even an interest rate environment where rates are lowering, PFLD actually has another screen within its portfolio where PFLD will screen out any preferreds that are trading 5% above their face value. So in a lowering interest rate environment where preferreds, which tend to have call options attached to them, that call risk tends to ramp up during times of lowering interest rates and increases reinvestment risk in that regard. So as far as interest rate risk goes from both sides of the fence, not just rising rates, but lowering rates, PFLD is pretty multi-purpose in that regard. So as far as its exposure goes, I mentioned, we're filtering from that initial universe of just, retail and OTC preferreds. And most of its exposure right now is within that what's known as a pretty desirable area of the preferred market, that OTC $1,000 par market. Close to 75% of its portfolio can be found in that particular space. So those types of securities tend to be variable rate in terms of their coupon structure. And that, again, is just another kind of side component of what makes PFLD from a duration risk, from a duration management risk standpoint.
The AAM SLC Low Duration Income ETF, ticker LODI, aims to deliver income through low duration fixed income securities. How does the fund balance yield generation with interest rate risk, and what types of bonds or instruments are most prominent in its current allocation?
Yeah, and so we're now moving over to the actively managed ETF segment of the AAM ETF platform. So LODI it's sub-advised by SLC Fixed Income. These are institutional money managers who manage a significant amount of money in that specific channel as far as fixed income markets go. And from an interest rate risk standpoint, LODI, it's actually very simple. So there's two major ways you're going to be able to essentially find value as far as an actively managed fixed income portfolio goes: duration management, and then the credit selection as far as the sector exposure of the overall portfolio. Interest rate risk is handled very simply. So LODI actually seeks to just match the duration of that of its benchmark, which is the Bloomberg 1 to 3 year government credit index. So as far as the duration management goes, it's expected to be anywhere from 1.5 to 2 years over the long term. So, towards the short end of the curve as far as that goes. But where a lot of its exposure is found as far as the credit bucket goes is in investment grade, but specifically in that single A to triple B bucket, primarily split between corporate credit and securitized debt as well. So think asset-backed securities, commercial mortgage-backed securities, and collateralized loan obligations, so CLOs. So as far as the selection process goes, this is a bottoms-up fundamental strategy where the team's looking for positive spread opportunities, particularly within the securitized markets, as well as corporate credit as well. So for example, like if I had to look at, if we looked at like the asset-backed security exposure of LODI's portfolio, most of it is expected to be in that triple B bucket, as I mentioned earlier. But over the life cycle of holding these different types of securitized bonds in the ABS sector, you have the potential to benefit as those bonds near maturity from credit migration. So maybe they bought it when it was a triple B rated bond, but maybe when they sold it or the bond matured, this hypothetically speaking could potentially be single A or double A as far as the overall credit rating goes. So theoretically, that's how they're looking to add value in the portfolio and capital appreciation potential and current income potential as well, because securitized debt tends to offer a pretty attractive yield relative to their corporate credit counterparts. So as far as like the overall allocation preference, there's two different investor types for a strategy like Lodi. One is potentially that cash plus investor. Naturally, there are risks as far as duration and credit risk goes, but for those looking to step out a little bit further onto the curve and take on a little bit more credit risk, there could be an attractive yield case there relative to that of a typical money market or money market like strategy. And then the other way is naturally in the core part of a portfolio. So we like to think of Lodi as really this core plus strategy on the short end of the curve, where there's a really nice diversification potential with this strategy as well. So for instance, the Bloomberg Aggregate Bond Index, which is typically viewed as like the S&P of fixed income land, that doesn't have CLO exposure. It barely has ABS exposure and CMBS exposure. So Lodi could potentially be a nice diversification value add there as far as the fixed income allocation goes.
Thank you, Chandler Nichols. I'm Brittany Mason with ETF Guide. Thanks for watching. We'll see you next time.